We talk about it with these changes to negative gearing recently, and you can no longer negatively gear existing property against your own income. We've had a client recently came and spoke to us that wanted to set this elaborate structure where they had, investment companies buying properties and things like that. Now, the accounting costs up front were about 10 grand. The accounting costs every year for this structure, just to be able to negatively gear an existing property, were another 5. So over a 10-year period, we're looking at accounting costs of about $60,000. Now, on top of that, the negative gearing benefits that they were going to get by doing an existing property in a complicated structure were not as generous as if they had purchased, for example, a new property in their own name. Once you add that all up, I think the difference over a 10-year period was something like $200,000 or $300,000. Now, if that existing property in the complicated structure outperforms the new property in your own name, for example, and makes an extra $200,000 or $300,000, sure, great. But if it doesn't, if they're very similar assets, you need to make sure we're not overcomplicating the structure just to try to get a particular negative gearing benefit or a particular access. It's about the underlying asset first, and then let's build around it.
I think it's about having a look at that overall plan and going, it's not just about that next asset, or it's not just about negative gearing, but it's just like you say, looking at the entire process, looking at the entire strategy and going, well, hang on a minute. Yeah, you're getting that asset and yeah, you're getting negative gearing, but if the whole structure is wrong and it's costing you so much, then are you actually getting the benefit that you want to achieve? Right? Okay, well, these are the pathways I was thinking about, and this works for this and this works for that, or this is what I need in pathway A and this is what I'm going to get in pathway B, and then you get to figure out kind of what's obviously going to be the best overall, but what's going to be the best for you and your lifestyle.
I guess, the wrap is save tax, no brainer, but what's your why? Let's build a strategy first and focus on good quality assets, not just the tax man.